Ladies and gentlemen, good afternoon and welcome to the Mass Financial Services Limited Q3 FY22 earnings conference call hosted by DAM Capital Advisors Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then zero on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pritesh Bam. Thank you and over to you, sir.
Hi, good afternoon, everyone. We, on behalf of DAM Capital, would like to welcome the management of Mass Financial Services, represented by Mr. Kamlesh Gandhi, Chairman and Managing Director, and other senior management from the team. We will have opening remarks from the management and then move on to the Q&A. Thank you and over to you, sir.
Thank you, Pritesh, and good evening to all of you. And I trust all of you are fine. And fortunately, the third wave has not hit us hard, and I hope it has played out now. And that is fine. That is a good sign for the economy and all of us to come back to track on normalization and hence the economic growth. The way we will do it is that I'll take you through the strategic intent of the company, how we manage this quarter and how we manage throughout this tough time, and how we have been managing since last more than 2 decades. Will be followed by my colleagues Dashra and Ankit will give you the detailing in numbers. Now, as shared with all of you through a press release, I am very happy to share that we have crossed the 6,000 crore mark on our consolidated AUM. And AUM at the parent company at MFSL grew by close to 15% on YOY basis, fueled by the rise in disbursement to 1,598 crores as compared to 1,031 crores the corresponding quarter and 1,476 the previous quarter. Our profit for the quarter-on-quarter basis, on corresponding quarter basis, increased by 11%. As you are aware that since last 2.5 decades, we have always been focused on calibrated growth, which brings about a win-win situation for all its stakeholders. And for a lender, maintaining the quality and profitability is of the prime importance along with AUM. Coming to the quality of the assets, as you have seen that even after implementing the 12th November circular, we have seen a very robust quality at around a net stage 3 asset of around 1.76%. And had we been doing the way we were doing earlier, it would have been around 163%. So this only marginal rise is a function that at Mass we have never followed a rollback once account slipped into 90, and the impact what we are seeing right now is the function of the real-time recognition of NPA, which usually was done at the end of the month by majority of the lenders. If I take you to the another very vital is the fact on capitalization, that we remain very strongly capitalized at 27.42 aggregate capital adequacy with around 24% in Tier 1 and 3.42% in Tier 2 capital. And as you saw, as you can see that from this quarter, we are coming back to our normal trajectory of almost a 20-25% growth, which we have demonstrated throughout all this decade. I would like to draw our attention to a slide on growth, where we have shared our motto and dictum on growth, that consistency and steadiness is the fastest way to reach where you want to be. And while we have always shared a 30 years or a 25 years journey, this time we have also endeavored to share the journey right from our first capital raise. That is a long period from 2007 to 2021. And I think all of us are aware that this has been the toughest time. This 14 years is a very long time, and there were a lot of headwinds during that time, right from a global crisis to NBFC liquidity crisis to demonetization to ILFS and then few of the other institutions failing and then the COVID. Despite of all those headwinds, we could register a growth of close to 25%, be it on AUM, be it on PAT, and corresponding growth in net worth also. This is where we gain our confidence, and this is where we are confident that if you have a strong balance sheet, the way we are having right now, with a capital adequacy which is a very enabling factor for the growth, accompanied by a quality which is maintained throughout the period of crisis, you can grow once you get the right opportunity, and I must say that has come now. So we are very confident going forward to come back to a trajectory of around 20 to 25% of growth, which translates into doubling our AUM every 3 to 4 years. Few of the things what we have done is to achieve this growth is to strengthen our distribution network. We have increased our centers reach from 3,500 centers to 4,100, and it is likely to touch 5,000 by March, which has been managed through our 114 branches, which is likely to be anywhere around close to 125 branches plus as we approach 31st March. This will be a great enabler for us, along with our NBFC partnerships and our partnership with FinTech, to achieve the growth what we are targeting with keeping quality and profitability intact. In terms of technology, we have always seen that technology should serve the purpose of, number one, is not compromising with the victim of extending credit where it is due. At the same time, it should improve efficiencies and it should result into customer delight. This is what we aim at adoption of technology, and this is what we mean by FinTech at Mars. That nothing should be done at the cost of at the cost of assessment on credit. Nothing should be done at the cost of extending credit where it is due. But at the same time, using the latest technology available, we should see to that how we improve on efficiencies, and that results into better experience for the customer. And we are in that process, resulting into more efficiency, and we see that improving forward. Be it onboarding of customer, or be it decision making, or be it operations, or be it collections once the disbursement is done. And in terms of our tie-up with FinTech, we are very cautious in how we tie up. We are very cautious on how we extend credit at the marketplace, and see to that we really create an all-round value for all our stakeholders. On the product configuration, we continue to focus on our prime product, that is micro enterprise, small and medium enterprises, accompanied by a Wiz portfolio of two-wheelers and commercial vehicles. In micro enterprise loans, which we do directly along with the NBFC MFIs of the country, we are happy to share that there is a lot of improvement in terms of collection. The NBFC MFI has started attracting more capital and more debt. Their collections have also improved. But at the same time, the micro enterprise entrepreneurs will still take more time to reach to the full scale, whereas we have seen a good growth in our SME portfolio. So if you see, our SME portfolio has registered a very robust growth of around 45% this quarter-on-quarter basis, whereas our micro enterprise loans has more or less stable or slightly depressed by around 4 or 5%, being a very cautious approach on the part of the company to wait and watch once the real economy picks up. We are working hard to improve on the Wiz portfolio also, and there also we are registering a decent growth in two-wheeler as well as commercial vehicle portfolio. Two-wheeler, we all know that is facing a lot of headwinds, but even though we could grow it by around 13%, and the commercial vehicle portfolio on a lower base, we could register a growth of around 47% in that. So overall growth was close to 14% on AUM. Coming to the housing subsidiary, there also we have always maintained that housing is going to play a very important role going forward, and we have started getting encouraging results there also. where the AUM has grown by around 11%, and with a very strong capital adequacy and very high quality of assets, we see no reason why it cannot come back to the growth of anywhere between 25 to 30% on a lower base, and that should meaningfully contribute to the parent company. So during this time of intense severity in terms of headwinds because of COVID, and that too on a prolonged basis for around more than 2 years, what we have focused was to strengthen our balance sheet, see to that the quality of the assets are maintained or are intact, and at the same time, we have taken this opportunity to improve our distribution strength also, all ready to capitalize on the opportunity that we'll be getting now onwards, once again to come back to our normal growth trajectory as we have demonstrated over decades. So with this, I will hand over to Darshana to take you through the numbers in detail, which will help you to understand the performance better. Over to you.
Thank you, sir. Good afternoon, everybody. So I'll quickly take you through the numbers. So if we look at our AUM, so as shared by sir, the growth in AUM is around 14%. And regarding the configuration of the AUM, micro enterprise loans are contributing around 50%, SME is 40%, and rest 10% is coming from our wheels portfolio. And regarding the growth percentage, SME book we have grown by 47.53%. Two-wheeler is up by 12.24%. So earlier the portfolio was at around 323 crores. Now the two-wheeler portfolio is 363 crores. Commercial vehicle portfolio has increased by 47.16% from 156 crore to 230 crores. And micro enterprise loan, there is a degrowth, as shared by, that was the cautious approach. So there is a degrowth of around 5.23% from 3,033 crore to 2,874 crores. SME book stands at 2,274 crores and it has grown from 1,541 crores. Now coming to the total income on quarterly basis, so there is a rise in income at around 21% from 142 crore to 171 crore. PBT has increased by 11.37% from 48.38 crore to 53.88 crore, and profit after tax has increased by 11%, that is 40 crore from 36.18 crore. On 9 months basis, total income has increased by 4.9% from 54.74 crore to 477 crore. PBT has increased by 8.4% from 143 crore to 155 crore. Profit after tax has increased by 7.74% from 107 crore to 115 crore. As far as quality of the portfolio is concerned, our gross stage 3 after considering revised guidelines, it is 2.35%, and net stage 3 asset is 1.76%. as compared to 2.3 and 1.8% respectively the last year. And if we would have considered it normally, then it would have been 2.18%, and gross stage 3 would have been 2.18%, and net stage 3 would have been 1.63%. Now coming to our housing numbers, here also we could register growth of around 11% in AUM. So now the AUM is around 307 crores. It was 277 crores last year. Total income has increased by 3.02%. Profit before tax has increased by 121%. And this is mainly because of lower impairment cost. Last year we had to provide more because of the COVID. Profit after tax has increased by 126% from 46 lakhs to 1.04 crore. On 9 months basis, PBT has increased by 22% from 3 crore 51 lakhs to 4 crore 28 lakhs, and the profit after tax is increased by 24.65% from 2.68 crore to 3.34 crore. Regarding the quality of the asset, our gross stage 3 is 0.69% and net stage 3 is 0.49%, and it was last year it was 0.65% and 0.46% respectively. Here I would like to mention that in our housing finance, we were following the practice of not upgrading the accounts unless it comes under zero DPD. So this is just because of this is the normal ECL. So this was all about the performance of the book of both the companies. Now I'll request Ankit to take you through the capital and liability management.
Good afternoon all. In the current quarter, because of the efficient liability management, we were able to maintain liquidity buffer of around 1,000 crore on the book and the unutilized cash flow facility of around 700 crore. In addition, the company has a sanction on hand of around 900 crore in the form of term loan, direct assignment, co-lending. In the last quarter, the company did around 300 crore direct assignment transaction with various PSU banks. The company further has more than 350 crore sanction on hand, which will be utilized during the current year as well as the next quarter. The company aims to maintain around 20-25% of AUM as off-book through direct assignment transaction and other off-book transactions. Also, we tied up with two of the PSU banks for co-lending to MSME sector, and we executed the transaction during the quarter of more than 50 crore. Company has available cash flow facility of more than 1,900 crore, out of which company maintained utilization level of around 65-70%, and this portion was kept as a liquidity buffer. Company raised around 450 crore term loan during the quarter from various PSU and private banks. This helped us to further strengthen the asset liability maturity pattern. The company further have more than 500 crore sanction on hand, which will be utilized during the current and the current quarter as well as the next year. The company raised around 100 crore market lead 100 crore through market lead debentures during the quarter. Also, we raised the subordinate debt, which qualifies the Tier 2 capital to the tune of 100 crore from private placement during the quarter. We have assessed our structural liquidity for the period, and based on the assessment, there is no negative impact on liquidity, and the cash flow in all the cumulative buckets remain positive. We remain adequately capitalized, whereby our total capital adequacy is around 27.41%, with Tier 1 of 23.84%, and adding the subject or Tier 2 capital during the quarter, it is around 4%. Our debt equity ratio is around 3.41 times, and we were able to maintain the cost of borrowing during the quarter, which was stable at around 8.80% on the entire book. So this is on the capital and liability management, and I will request sir for the closing remarks, and then we are open for question and answer round.
Before we start the question answer round, I missed out on one point, that the board in its meeting yesterday have approved the dividend of 1.25 rupees per share as an interim dividend, and that has been approved yesterday. So that is what I wanted to add in my opening remarks, which I missed out. So now with this background, we are open for any query or any question answers, so if anybody wants to ask.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touch-tone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. In the interest of time and fairness to all participants, please restrict questions to 2 per participant. If you still have more questions, please join the queue afresh. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. The first question is from Hitesh Gulati with Haitong. Please go ahead.
Yeah, thank you for taking my question. So I have a couple of questions. Firstly, so what is your view on credit costs? So credit costs have obviously come off this year, but how should we think about it going forward over the next couple of years? And secondly, sir, I observed that our on-book AUM has kind of increased to above 80%, which is kind of highest in the last few quarters. So what is the thought process there?
I think our credit cost has been around 0.8%, and we see that as a normal credit cost. And as we already have, as you know, we already have a buffer over and above that of around 0.95% of our on-book asset, and we continue to maintain that buffer. So we see that things have normalized, and we don't see the credit cost going higher. On the contrary, because we follow Ind AS and ECL, we might have to claw back from our buffers, which we'll do it gradually and slowly. On terms of our assignment, we would like to share that we'll keep it range bound between 20 to 25%. And the very reason for lower assignment was not lack of sanctions, but our conscious effort to reduce liquidity on the balance sheet. If you see that over last 2 quarters, we have been maintaining very high liquidity, and that cost the company. So if we sell the portfolio despite of having sufficient other lines of credit, that we have to draw it at a time when we say sell the portfolio. So it was a conscious decision to limit that to around 18%. We are further in the process of reducing the liquidity because the things are normalized. We did not carry very high liquidity on the balance sheet, which affects the profitability. So I think this year we'll be in a position to maintain anywhere between 18 to 20%. But as a policy, it will be range bound anywhere between 20 to 25%.
Thank you, sir. That's it from my side.
Thank you. The next question is from Gurjot Aluwalia with AG Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. If you can just explain 2-3 P&L line items. So one is on the interest finance cost. I see that is up 7% year on year, but the cost of funds have actually come down 3-4 basis. So if you can explain why finance cost has gone up higher than the AUM growth. And secondly, on the fees and commissions, they rise substantially both year on year and quarter on quarter. So where do we expect the fees or commissions to stabilize? Like last quarter, it was 0.5 crore versus 4 crore Q2 and then 0.7 crore last. Yeah, where do we expect to stabilize as percentage of revenue or absolute figure?
Yeah. So on finance cost, it is also related to my off-book or direct assignment transaction. So if you compare with the last year, my direct transaction was around 33%. And when we do a direct assignment transaction, the net income is booked on my gross income. So what all costs I incur or finance cost, that will not be shown in the finance. It will be a netted income in my gross income. So this year it is at 20%. Therefore, the effect of on-book borrowing is led to increase in the borrowing finance cost during the quarter.
And on the fees and commission, there are 2-3 things which will lead to the increase along with the increase in the business and along with our change in the policy of doing the business with the partners, whereby first we used to share the revenue and each one will take the revenue. Now for better control, we book the complete revenue in our books and then we would give them the commission what we need to give to them. So as a better control, this has been practiced. So as and when we have more and more of such arrangement with the partners, whereby the complete income has to come in our book, and then we will share from that. That will be reflected in fees and commission.
Got it. Thank you. Then the second question is, Just again, based on what you have given in the presentation, so you mentioned the leverage ratio on the balance sheet is 3.41, the debt to equity, and then you going forward will maintain this leverage at optimum level. So again, can you just quantify this optimum level of debt to equity in the next 2-3 years? And also the growth trajectory of 20-25%, is this AUM growth, PAT growth? Again, if you can just define both these things.
Starting with the last query, when we talk about 25%, it implies both the AUM growth and corresponded by the PAT growth. If you see, as I shared in my opening remark, if you even see the last 14 years of working, the AUM growth and PAT growth in PAT corresponds to each other. So that we mean AUM and PAT growth both. And in terms of leverage, I think anywhere between 3.4 to 4.25 should be ideal leverage as we think currently.
Got it. Thanks a lot for clarifying. All the best.
Thank you.
Thank you. The next question is from Madhuchandra Dey with MC Pro. Please go ahead.
Yeah, hi. I have two questions. One on the asset side. As you mentioned that SME growth was healthy, and you also had certain partnership with banks for co-lending. So what was the percentage of origination in the quarter that came from, this partnership? And a related question is, we have seen in this quarter banks have gone very aggressive in the SME and SME space. So what is your reading on the same? I have a question on liability, which I'll ask later.
See, as Ankit said, the partnership is newly started, so it will not be in percentage of the disbursement done in this quarter. We have done close to 50 crores of partnership business, and which will scale up going forward as we synchronize our systems and operations with both the banks which we have tied up. As such, there are ample of opportunity for partnerships, but we are taking one by one. As we season one partnership, will move to the other partnership. So there is no dearth of getting into partnership with the various banks, but we will gradually move up once we scale up with a particular bank. So that was 50 crores, and our current partnership is with Bank of India and Bank of Maharashtra. In terms of banks becoming very aggressive in SME funding, I think while optically it looks like that banks are very aggressive, but there's a lot of market differentiation at the marketplace, that the customer whom we serve and typically which bank will like to serve, and the USP what we bring to the table, along with now adoption of technology at our end with lot of API integration and lot of software updates. I think we once again are better in customization of credit as compared to bank, and we see a lot of traction in giving credit to the SME sector the way we have been doing. So while banks have expressed the desire to be very aggressive, but all said and done with the best of their efforts, when it comes to customization, it is where people look up to NBFCs, and with as I shared along with technology has helped us to scale up this business, and we see this traction going forward.
My question on the liability is very simple. There seems to be a sequential increase in the cost of funds. Any particular reason? Is it because the assignments have fallen so much? Can that be one of the reasons, or what is it?
It entirely depends on the mix of borrowing. See, because in the last quarter we raised subordinate debt, which is a tier 2 capital, and because it's an unsecured subordinate debt, it will be costing higher than the normal cost of borrowing to the company. And also gradually once the other stuff is when we borrow a long-term loan, it will be always higher costing than the short-term loan. So when the mix changes, there can be slight increase in the cost of borrowing, or it can be other way, it can reduce also. But it will remain in a bucket of 8.75 to 9% going forward also.
Okay, thank you and all the best.
Thank you.
Thank you.
Thank you. Again, if you have a question, please press star and one on your touchtone telephone. The next question is from Rahul Maheshwari with Ambit Asset Management. Please go ahead.
Thank you to the entire team and congratulations on the good set of numbers. I have three questions. Can you give a little bit more color on the co-lending partnership, that what kind of products you are doing, what is the kind of arrangements, and whether how much ROA accretive it's there as compared to the traditional business in your own books which you were doing earlier. And you talked about many such more partnership is there. If not giving the names, at least you can give some kind of color or insights on what type of products or what kind of in terms of number of partnerships you are planning such.
So in terms of partnership, if I start from the latter part of your question, we'll be introducing a few more products such as housing loans, and we will have different type of products with different banks, because when we talk about MSME funding, we have various type of credit screens, and the screens which suits the bank, there we enter into a partnership, maybe a secured loan. Somebody will be happy with the secured SME, somebody will be comfortable with the unsecured SME, whereas we have the complete area of products to offer to the banks. So the partnership with the banks will depend upon the convergence of our product lines with the banks into the bank's product line. And there we initiate a process with them to partner, and then we try to converge as much as we can, and that convergence had happened with Bank of Maharashtra and Bank of India, both for secured and unsecured MSME. And going forward, once
80-20 ratio, 80% of the...
Yes, it is 80-20, and in some places we also prefer to go up to 70-30 also, depending upon what are the terms we get from the bank. So it can be 80-20 is the minimum, but at some places they can also be doing 70-30, where the risk and reward are shared pari passu. In terms of ROA, we look at partnership as one more model of liability raise. So we see to that the ROAs are maintained as if we have raised the liability on our own balance sheet, while we get the advantage of sharing the risk with the bank. Because what happens that for us, partnership is not because we are not in a position to raise liabilities, but partnership is because we can have a better diversified relationships with the bank, where we already have other sort of relationships like normal assignment or normal term loans or normal CC. And how it operates is that there are two models. That there can be an online disbursement, or there can be a reimbursement model. But for the operational convenience, RBI recently amended maybe 2 quarters back, okay? 2 quarters back they amended that it can be reimbursement module also. So first we will book the business as per the mutually agreed credit screens, and then the bank will reimburse after they are convinced that it is as per the agreed credit screen.
So Dhwanil, in this co-lending model, apart from the 80-20 in terms of the disbursement and risk sharing, what kind of fees generation is also being taken by you?
See, what happens is that a particular IRR is decided at the customer level. And from that, the bank will charge their part, and then we will charge our part, which will include the fees and the services amount that we have to do for the complete 100%. So for us, it is as good as a liability raised at around 8 to 9%, and then the lending done at anywhere around, say, in the range at an average IRR of say around 14%. So we get a 6% spread, so to say.
Yeah, that's very helpful, Dhwanil. The second question I want to ask that very phenomenal asset quality, I would say, looking at how the peers has given. How come MAS, looking at what you are lending to the partner NBFCs, can you give some color on it, that how it has remained so benign and where others have actually faced many issues, irrespective of the products, whether it was CV loans or SME or etc. So, and also, can you give a color on how the end customer or NBFC's partners' asset quality has behaved?
Coming to the overall strategy of extending credit where it is due, and you see that over the years we have been a very patient organization, nevertheless sleepy, because when you double your AUM every 3 to 4 years, it's a phenomenal growth by any standards. But we have taken a lot of time to reach to this size from a humble beginning of 2 crores in 1995. Have stick to our niche expertise. If you say that in 2000 we are reckoned as an MSME financer, in 2021 we are reckoned as an MSME financer along with a small portfolio of wheels. So over all these years we are focused on gaining the niche expertise, grown in a calibrated manner, but in such a manner that a very healthy growth is registered, and at the same time always being cautious at the opportunity that the market offers. Say for example, during COVID, in one of the year, we could dare decrease our AUM also by 11 to 12% because we thought that there's not an opportune time to increase your AUM. So the policy of not growing at any cost, putting quality and the profitability or prioritizing them along with the growth. I think there are few simple things what we have followed over all these years, and that is what has helped us to maintain our quality. In terms of our NBFC partners, we are very selective on with whom we work. The risk sharing arrangement is such that it is with complete recourse on the partners we work. So their capital and their spread works as a buffer for us in case of any eventualities, and that has worked very nicely for us for more than a decade. So this has been our business model. The simple formula is that we have stick to a particular product, develop this expertise, had been patient, and had grown at an opportune time.
Ronil, just quick on.
Sorry to interrupt you, sir. This is the operator. Mr. Maheshwari, again, if you have a question, please come back in the question queue. Thank you. The next question is from the line of Bharat Shah with ASK Investment Managers Limited. Please go ahead.
Yeah, good to see the kind of results yesterday. 2 questions. Given a lot of water has flown under the bridge over the last 2 years and an unprecedented situation the whole country has faced, and if broader consensus appears to be that things are headed more to normalcy rather than disruption, and there can be occasional some trouble here and there, but broadly I think things are moving towards normalcy. So if that assumption is right, are we back to the game of long-term growth of typically 20 to 25% and more like 25 to 30 that we have done in many periods? Are we back to that kind of a compounding growth rate in the business?
Yes, Bharat. So given the opportunity and once the things are back to normal, our customer style of under promise over deliver, our endeavors will be to be anywhere between 25 to 30%. But once again, prioritizing as shared with all of you that it will be quality, profitability and growth. But you are absolutely right that we would be trying to see to that how we can recoup the lost ground once the thing stabilizes. And we still have a scale whereby few percentage growth more can be taken, and there will be full-fledged endeavors on that count. And internally we are geared up that way. But when it comes to commitment, we always try to give the commitment in such a manner that we don't overpromise. So on a commitment basis, the endeavor will, it is on a 20-25%. On endeavor basis, it will be definitely anywhere between 25 to 30%. and I hope that we might exceed that expectation of 25%.
Right. And Kamlesh, secondly, how do we see our, once again, if you have to revisit our ROA 3, the return on asset 3 once again. So from a conceptual point of view, let's say what kind of a spread between our cost of borrowing and the lending rate, effective net interest margin, other income including assignment income, and then the expenses, then the likely credit cost, and then the profit after tax margin and the leverage. If we drop the schematic kind of ROA 3 again, just to revisit, can you help me with that as to how to conceptualize the way our business will be modeled overall?
See, broadly on an AUM basis, we target NIMs at around close on a range bound basis from around 6.75 to 7.5%. And historically, we have credit costs from 0.8 to 1.2%, and then the operational cost of say around 2% should leave us at around 4% of NPM and post-tax ROAs of close to 3%. This is what we always targeted. And our experience is that a 3% ROA on a 7% NIM renders us more competitive also in the market to choose and pick our assets also. Because if we target higher ROAs, it will come at a cost of quality, and you can never control that once that deteriorates. So on a ROA 3, we would like to stick to around 3% ROAs and 7% NIM, and then between the credit cost and the operational cost at around 4%.
And what kind of leveraging then? Structurally?
Structurally, we will like to, on balance sheet leverage will be at around 4% for 4 times. But if we take the assigned portfolio of 25%, the leverage will be anywhere between 5 to 5.5 times. That will take us closer to around 16 to 17% ROE.
Sure. On book about 4 times, and total book basis about 5 to 5.5 times.
Right.
Yeah. Then that will be leveraging. So net worth will be separate, right? Meaning 1 rupee of net worth and 5.5 rupee of on book, off book leverage, or totality of 5.5.
Totality. It will be 1:4 can be our debt equity. So the 1 is coming from equity, 4 is coming from debt. This gives us our on book balance sheet, and another 1 will come from 1 to 1.5 will come from assignment. So it is 1 to 1 to 5 to 5.5, and 3 to 3.25% of ROAs should take us at close to around say, anywhere between 16 to 17% of ROE.
No, that should then take us to 18 to 20% ROE. Because on book 1 rupee and 5 to 5.5 on book and off book.
I'm sorry. That will be so that will be 18% ROE.
18 to 20% ROE.
Yeah. Right.
Okay. So thematically, this is a picture we can imagine on a generally more rugged and sustainable basis.
And that is if we take last 2.5 years away, that is what we have been usually done. That created ROEs in the range of around 18% and maintain NIMs of around 7% and ROAs anywhere between 3 to 3.25%.
And one last question, given that now things are looking back into the saddle, we have gone through a difficult, challenging experience of pandemic and managing situation. As things are opening up and hunger is coming back in the system, probability is that instead of 2025, we may grow at 25 to 30 because India at the end of the day still remains materially credit deficient society. And the capex cycle, export performance, commercial credit, consumer credit all seem to be opening up in a nice way, including the corporate credit. Therefore, if we supposing we are able to grow based on our model at 25 to 30%, keeping the hygiene, quality of the asset in calibrated, measured growth that we typically follow, with 18 to 20% ROE, that will leave some amount of gap in the capital. Will it mean that we may leverage more, or we may have to raise some capital?
Okay, as far as capital is concerned, I think we will have to leverage if we take a 30% view. So we will have to raise the capital. So it all depends upon the extent possibilities on the availability of the liability and the liquidity at that point of time. But as a policy, we would like to stick to this and see to that if we really want to grow at 30%, then we'll have to raise capital. So when we talk about a self-propelling model, one of the ideas of keeping the growth at between 20 to 25% was also that this is a self-propelling model. But having said that, we will not lose one opportunity if we have one only because we have to raise capital. So we will definitely balance between the opportunity available without compromising with the quality of the assets. And if we can grow at 30%, maybe with a slight capital raise, so be it. But we might increase the leverage marginally, but not very high.
Okay. But at 18-20% ROE, what kind of growth rate we think can be sustained within in a self-sustaining way?
See, as you know that currently we are at an excessive capital of around 24% Tier 1. So we have some room to draw from that capital. So if I talk about the next journey, say from around 6,000 crores to 10,000 crores through our internal accruals, we will be in a position to maintain our Tier 1 capital anywhere close to around 18 to 19% and add another 2-3% of our Tier 2 capital. I'm talking on AUM when I'm talking about the total AUM, and that will result into, say, if I'm maintaining 18% Tier 1 capital and with around 20% on assignment, that will be a statutory capital adequacy of close to 23% and a leverage of close to 4.25 times. So if on a 10,000 crore balance sheet with around 18% Tier 1 capital on AUM and then de-risking to 20 to 25%, I think will be a self-propelling model, and it can go on accordingly going further also.
So about 18 to 20% ROE and about 23-25% asset growth can be self-sustaining, self-propelling model.
Yeah, in self-propelling model.
Beyond this, capital may need to be raised.
Yes, and you might need to raise the capital.
Okay. Yeah, thank you, Kamlesh.
Thank you. Thank you.
Thank you. The next question is from Harshvardhan Agarwal with IDFC AMC. Please go ahead.
Hi, sir. Thanks for the opportunity. So just wanted to understand a bit on the fintech tie-ups that you mentioned in the PPT. So what was the quantum of disbursement that you have done during this quarter through this tie-ups? That is one thing that I wanted to understand. Another is what is the target disbursements or this business that we expect from this fintech over the next 12 months? And lastly, is how the collections work in this type. So these are the three questions around this fintech types.
See, the fintech types, what primarily we will aim is around catering to the MSME customers. This will be the preferred fintech ones. And in this quarter, we on a trial basis had undertaken a disbursement of around 200 crores. And going forward, we see that if we get the fintechs who are converging with our idea of extending credit where it is due, and if we are satisfied with their systems and operations, so that we can onboard the customer based on their technology, we see that business around 25 to 30% coming through such fintech tie-ups. In terms of collection, it is directly being credited to our account, and the fintechs will get their share of origination and servicing, and it is through an escrow mechanism, and they get an agreed spread for origination and servicing, and to an extent taking the first loss guarantees.
Right. So, sir, when you say currently it's an escrow mechanism wherein the money comes into your account. So So my assumption is, like, just in case if a borrower is not able to pay or has delayed his EMI, so is it like in that case the collection, the Mars will do the collection work, or it's the fintech will do the collections on behalf of Mars?
So what we do whenever we tap with a fintech, there is a common credit screen device. Area of operation, unlike that fintech works throughout the country, our area of operation is limited only to the pin codes where we have the reach. We would not be doing across the country. The preliminary responsibility will be of the fintechs to collect, but we have a fallback arrangement that failing which we can step in the shoes very easily, because it is only within the area where we operate by and large, and it is as per our agreed credit screen, and there is a back-to-back credit appraisal done. No disbursements are done continuously without our credit appraisal. So it is just using the platforms whereby due diligence and everything is done through us.
Right. And so one last thing around this is on the disbursement number that you shared. You said like 200 crore disbursement is done through fintech during this quarter, and maybe the target is somewhere around 25-30% through these platforms. So if I were to assume like 1,500 crores of disbursement in a quarter, so maybe somewhere around say 400 crores of disbursements you would expect to come from this platforms. Is that understanding correct?
Yeah, going forward, if we converge on the operations systems and and the experience is good.
Yeah, sure. Thanks a lot, sir. Thanks a lot.
Thank you. The next question is from Rahul Jain from Credence Wealth. Please go ahead.
Thanks for the opportunity, and special mention for the management team for a decent balance sheet and also decent asset quality in extremely tough times. Coming to my question, sir. So we are coming back somewhere near to the normalcy, but as what we understand from various company concalls, rural has faced problems. Rural economy has slowed down, and also given the scenario in last 2 years, what we get to hear is even at the urban level somewhere, the larger have become more larger or more stronger, and some headwinds are being faced by the smaller guys. So given the set of customers to whom we lend or the segments to whom we lend, what is your view on the same in terms of normalcy being there, to what extent, and which segments where do you feel there are still stress pockets there and it will take some time for normalcy? Accordingly, your growth targets of around 20-25% over a period of next 3 to 4 years compounded, do we see that this will be more back-ended rather than seeing that kind of number in next 12 months?
See, coming to your first question, if you see our asset configuration is more, not exactly rural, but tier 2, tier 3 cities. So they do not fall under a classical definition of rural, whereby they are more agri and animal husbandry or some petty occupation-oriented income. So whereas we work with the ones which are a few notches above the rural. So it is not typically that rural economy we serve. Secondly, on the stress pockets, as you see that in the last 2 years, there were hardly any pockets where there were no stress. So it was all pervasive. But it was only up to the lenders to see that have you chosen, pick your borrowers in terms of how you select the segment, how you select the demography, and over and above that, what are your credit assessment techniques. And that is once again the function of your growth plan. So if you have a balanced approach there, that is the way we have navigated, and I think that is a good way to navigate through any of the stress, not only COVID stress, but as I shared in my opening remark that since last all these years, we have navigated through various stresses in this way. In terms of the growth of 20-25%, by and large should be on an equal trajectory. Take away few points here or there. That 1 year we have grown at 22 and the next we grew at around 27 might be practically possible. But the idea is to grow steadily anywhere between 20-25% over these years, and we have done that way in the past also. That we grow steadily, not so much of a lopsided if we take a 3 to 5 years time period. It's not so that it's lopsided in the last 2 years on a 5 years time horizon. It is more or less steady. So we with normalization, our endeavors, as I replied to Bharat Bhai's query, that our endeavors will be to have a steady growth.
So can I assume that within the segment which you are lending to, normalcy is more and less done? Is that what you're trying to hint at?
Yeah, as we talk today, yes. As the way we are seeing the traction, and since last almost 1.5 quarters, we have reasons to believe that we are almost normal.
Sure. And sir, my second question is, currently what percentage of your AUM is by partner NBFC? And given that you are aggressively putting up more centers, you mentioned already we are at around 3,500 and aiming to be 5,000 by March. Does that proportion change in next 1 or 2 years or 1 to 3 years? Is that what you're targeting or trying to do?
In fact, it has started changing. If you say last quarter, the configuration was 58-42. Now it is 50. That 58 is reduced to 52 in terms of NBFC distribution, and 48 through our direct distribution. And by March, we might see that being 50-50. And as I've always said since many quarters, that over a period of time, while we have no issues through NBFC distribution, but the only fact that our distribution strength will increase at a faster pace than our NBFC partnership. The ratio will be skewed in favor of our retail distribution, which can be going forward 60-40 or maybe going at 70-30 in favor of our direct distribution.
Okay, sure. Thank you so much and wish you all the best.
Thank you.
Thank you. The next question is from the line of Sarvesh Gupta with Maximal Capital. Please go ahead.
Thank you for taking my question. Sir, if you have to look at your AUM composition, it is...
Hello, Mr. Gupta. Your line has been muted to ask a question.
Yeah. Good evening, sir, and thanks for the question. So, in terms of product-wise breakup of your AUM, we are almost like 50% plus into micro enterprise loan, and that's where we feel that still not able to grow, and even the commentary has been cautious only. So we are not sure how things will unfold. And given that, how do we see this 20-25% sort of a growth trajectory? Because if one largest segment is not growing or not growing at a rapid pace, then how do we compensate for that? Do we see enough buoyancy in the SME loan market to be able to pull the overall growth to that level? And if that be so, then would we not end up making any mistakes, given that that segment also has been facing some challenges of late, and it's been like that for a few years.
See, while we give a bifurcation on micro enterprise loans and small and medium enterprise loans, but when we take this as an MSME segment, it is SME and micro enterprise both. And when we talk about micro enterprise loan, the cautious commentary maybe was and maybe for a quarter or two, but it's not so that it is going to remain there forever. It's a very huge market to be served, and we have a very strong presence there. But having said that, let me take you to the fundamentals that once you grow your balance sheet size, and as a practitioner over all these decades, we personally feel that you have to commensurate your ticket size also with the same in order to get the growth. So if you see, as mentioned in our press release, that we are focusing more on SME loans, and last quarter we could grow SME loans to the tune of 47%. So we are seeing, and we are not new to SME loans. The only thing is that we are increasing our SME loans in consonance to our balance sheet size. So as we grow our balance sheet size, we'll be increasing the portion of SME loans. So SME loans at a particular stage, a quarter or two back, was not a function of lack of origination or lack of our capabilities to originate that, but a cautious decision to limit that looking to our balance sheet size. So as we grow our balance sheet size, we will be more focused on SME loans, while focus on micro enterprise will continue. So when we talk about a 25% growth coming from this MSME sector accompanied by wheels, the formula will be to focus on SME, micro and wheels in priority.
Understood, sir. And other way to grow probably is to have more of a geographic expansion now. While you are increasing your distribution points, are you also planning to sort of put in more new geographies in the coming this 12 months or so?
Like we have operations into 6 states. And we are exploring. We are trying to explore north also especially for SME business, and few more geographies in south. So that will be a continuous exercise depending upon our requirement for business. But for the next quarter, as I shared, that our 4,100 reach will be 4,500 reach, mainly within our 6 states of operation, and we will be simultaneously exploring more centers in south and exploring north also.
Understood, sir. Thank you, and all the best for the coming quarters.
Thank you.
Thank you. Ladies and gentlemen, due to time limit, this was the last question for today. I would now like to hand the conference over to the management for closing comments.
So thank you so much, everyone. We were happy to share the performance of the company for this quarter, and we are confident that the way we shared with you, it will be a good growth journey going forward, looking at the normalization of situation, and accompanied by very strong enablers that we have in terms of capital adequacy, niche expertise, capabilities to raise liability and to manage asset quality. We see that coming back to the normal growth of around 20 to 25% is given, which results into a very strong compounding growth of doubling the AUM and profitability every 3 to 4 years. So as Team MAS, we continue to focus on our mission of excellence through endeavors, which can create value for all the stakeholders. And we'll be in touch, and please feel free for any further query. Thank you. Thank you so much.
Thank you. On behalf of DAM Capital Advisors Limited, that concludes this conference. Thank you for joining us, and now you may disconnect your lines.